In the age of technology, we see people everywhere living the most extravagant lives, the most expensive supercars, mansions, and everything else you can imagine. At first, these may seem like completely unattainable material objects, but the fact is, with proper financial management, you too can achieve your wildest dreams. The first step in breaking out of your financial barriers is achieving a solid income. The process of landing a job is broken up into 3 steps: making a resume, reaching out, and the interview. The first step in constructing a well put together resume is collecting all of your achievements, no matter how minute, from the past several years. Student of the month, honor roll, honor society, and any clubs that you're a part of. When putting together a resume, use certain buzzwords in order to make each accomplishment sound so much better. In the description is a link to a resume template where you can compile all of these in one document. Personally, for my resume, I like to use LinkedIn. It's easy to add and you can flex on your friends any achievements. Once your resume is completely put together, the next step is searching for a position. This is where using LinkedIn makes life so much easier. Open up a search on LinkedIn and look up students. You can find any position you're interested in with an entry-level experience looking to hire students. But the more likely option is going to any local stores where they know you pretty well and see if they're hiring. From there, hand them your crisp new resume and expect a call. The key is to keep moving forward. If someone may reject you, just move on to the next. And once you land an interview, start doing a little research on the company that you're looking to work at. The standard company questions will be asked, like what will you do in this position? And the best thing to answer that question is just to imagine the perfect hire in your shoes, what they would do, how they would conduct themselves, and simply convey that to the hirer. But there's one thing that can get you to the next level and make sure that you land that job. Believe it or not, the hiring staff on these companies are just people, and like all people, they love to talk about themselves. So at the end of the interview, ask any questions you have, compliment company culture, and do whatever you can to express your interest in what they're doing as a corporation. So once you land this new job, how do you collect your money? And where do you even put it? If you haven't already, look into creating a checking account. Ask your parents which bank they use, and look into what type of checking accounts that this bank offers. Do your research and look through the conditions. Make sure that your checking account doesn't include high interest rates, account minimum fees, or overdraft fees. Other steps you need to complete include filling out your Form I-9 and getting your working papers in, but these steps are really simple and have no need for an explanation. Now that you've got your hard-earned money in a checking account, how can you get ahead of the curve and start building your wealth for the future? Well, first, it helps to understand some financial terms you may be met with in the future. The first being a credit card. You can think of credit cards essentially as a loan that you're responsible for paying off each month. Different from a debit card that you may already have connected to your checking account. A credit card does not directly withdraw from your funds. When you make a purchase on a credit card, you're taking money from the bank's account. Only when you pay your bills at the end of the month does that actually draw from your personal account. And you may be asking, why would I want to use a credit card? Using a debit card seems so much easier. Credit cards have several advantages over debit. The first being fraudulent purchases. Let's say, for instance, your credit card was stolen from you and someone is making purchases on your account. If you notify your credit card company, you will not be charged. However, if this same scenario happens, but a debit card was stolen, you most likely would not be able to get any of your funds back. Additionally, if you are able to pay off all of your credit card bills on time, you can accumulate something known as credits. You can think of your credit score like XP in a video game. If you're playing a video game and you lose a bunch of matches, your XP will lower. But when you are successful, your XP will increase. Now let's imagine you and your friend want to run duos. What do you think is going to happen if you ask them with low XP? If you answered they're going to ghost you, then that would be correct. This is because when you have a low XP, you're showing your friend that you have a reputation of, well, being trash. In the real world, as opposed to XP, this credit score ranges from 300 to 850. If you are able to pay your bills on time, your credit score will increase, and this lets banks and companies know that you're reliable. This means you have a higher chance of getting a loan, being able to buy a car, or being able to buy a house. Just like your duos partner when you were playing that video game, in real life, if you have a high credit score, companies and banks will be happy to help you out because you have a track record of being reliable and being able to pay off your bills. The second term is known as assets. Going back to the video game example, imagine that you're trying trying to sell your accounts. You wouldn't just think about how much virtual currency you have. You would think about everything that you own, what player your character is at, any items you got from the item shop, or any other exclusive item or achievement that your character may have. These are all assets, defined as resources with economic value. Assets can include property, stocks, bonds, as well as other resources. I'll go through each of these examples and tell you the individual benefits. The first example, owning property. Owning a property allows you to rent this out to tenants, or even put it up on Airbnb. Aside from setting up the property originally and maintenance from time to time, the daily upkeep is relatively low on property. Because of this, owning property allows you to achieve God-level financial status with passive income. Not only this, but over time, property values increase, something called appreciation. This allows you to buy the house, then for years achieve passive income by renting it out, and then finally, when you decide to sell it, make a profit and sell it for more than you originally bought it for. I hope it's clear now how great of an asset to have property is. Now let's move on to the next asset. Stocks. When you buy a stock, you convert your cash into share of a company. This means that as the business succeeds or fails, your stock prices follow in value. Let's use an example to help better illustrate how stocks work. Imagine if I were to create a company. My first step would be to pitch this idea to investors. If these investors have faith in my idea, they can sponsor my IPO, or initial public offer. This IPO will dictate how many shares of my company I'll be creating and the value associated with each individual share. Now, with my company on the market, individual people can offer up their money and buy shares. With this money raised through stocks, my company can reinvest and reach out into new fields of study, creating new products and more potential for growth. You may be wondering, whenever you look at company stocks, why do you always see that illustration of lines going up and down in an unpredictable way? This is how stocks can get risky. When trading on a public market, so many different factors can lead to an increase or decrease in market value. Let's use an example to help illustrate how stock prices can go up and down in value. Imagine I'm creating a company named Blues Shoes. Blues Shoes reach into an untapped market. They're able to reduce stress in your daily lives and increase your height by 3 inches. When I pitch Blues Shoes to investors, they go crazy and start to sponsor my initial public offer. From there, I go on a media tour, telling everyone about this new company, Blues Shoes. Now that the word's out, people begin to buy stock in Blues Shoes, and the stock price increases. With this investment money, Blues Shoes comes out and creates a new product, Nutri-Shoes. Shoes that fuel you throughout your day. As soon as this new revolutionary technology is announced, people begin to rush in and buy more stock in my company. That causes the stock to increase. However, once this product is released, it's found that people are developing an illness related to the shoes. Because of this, people start to worry and start to think that Blues Shoes is not the next best thing. And when people worry, they lose faith. And when they lose faith, they begin to pull out their money. And when their money is pulled out, the stock price plummets. Aside from good versus bad press, there's also several other factors that can impact the stock price of a company, including current world events and our country's economy. I mean, one time, Kylie Jenner put out a tweet that no one uses Snapchat anymore, and that caused the company to lose $1.3 billion in market value. Overall, stocks are just a lot riskier than real estate, just because of how difficult it is to predict the market, unless, of course, you're insider trading like 97 members of Congress. But one common sense tip shared by many investors is just to invest in large companies with a history of high return. This is what's known as blue chip trading. Most of the people who have received high return on their stocks is just because they've stayed in the game for multiple years and rode through those dips and high points in the stock until they eventually saw their investment increase in value. The third asset is known as bonds. Bonds, similar to real estate, are a lot less risky than stocks. You can think of bonds similar to a loan, where a company receives a certain amount of money from an investor. When this investor gives their money, certain values are set up: the coupon or interest rate, the maturity, and finally the face value. Coupon or interest rate is essentially how much percentage of the investment that the establishment gives back to the investor over a certain period of time. The maturity is essentially how long this bond lasts. how long the investor will have to wait until they get all of their money back in the establishment. And the face value is essentially how much money the investor pays to this establishment. Let's imagine there's a government that's looking to build a brand new bridge. However, this government doesn't have adequate money in order to fund building this bridge. As a result, they begin taking bonds, and the government sets their interest rate at 5% and the duration to 5 years. Let's say one person were to purchase a bond worth $1,000 at face value. With all this money raised through bonds, the government is able to build this bridge and begin raising tolls on anyone entering and exiting that bridge. Meanwhile, before the maturity of the bond, the investor that put up $1,000 at face value is able to receive $50 each year. Once this bond finally reaches its maturity, the investor stops receiving $50 a year in interest, but they're able to get their $1,000 back because the bridge was able to raise their funds and make back this money through tolls. Bonds are generally seen as a very safe way in order to generate passive income. However, things can sometimes go wrong. A great example of the downside of bonds and the banking system in general is what happened to Silicon Valley Bank. In 2022, SVB received 3 times their normal amount of deposit. As is normal for many banks, SVB then put this money into bonds. In order to fight off inflation, the Federal Reserve raised the federal fund rate. However, when the federal fund rate increases, the value of any bonds made before this increase decrease in value. SVB then put out a notice saying that they were looking to get back the money that they lost through these bonds. As a result, customers at this bank began to panic and withdraw their money. Because the federal funds rate increased, the value of the bonds decreased, and SVB had to sell their bonds for less money than they paid at face value, essentially meaning they lost money through these bonds. As a result, these investors began to lose hope in SVB, so they took their money out of the bank stock. Because of this, worry spread to so many customers at SVB, leading to what's known as a bank run, where essentially so many customers rushed to the bank and wished to withdraw all of their assets. Because SVB had so much of their money wrapped up into bonds and they were selling these bonds at a deficit, they could not handle all of these requests to withdraw funds. This led to the government and the FDIC taking control of SVB Bank. Now that you know how to make money and how to be responsible with it, you can go and chase your financial dreams. So start earning, start saving, and start to see your future form in front of you. See you on Saturday for a more in-depth discussion on personal finance. We hope you learned something new on this week's explainer video on Teens Tea. If you did, share it with someone you know, because knowledge withheld deteriorates, but knowledge spread proliferates. Have a good one.